Hello there everybody and a very warm welcome to Beyond Markets, a webcast brought to you by Julius Baer. Now we're going to address one of the most significant developments facing investors this year, higher interest rates. In the last month, central banks have been hiking interest rates to help bring inflation back under control. But despite a slow decline in inflation in recent weeks, central banks are continuing to keep rates higher. Currently, the Fed has rates at 5.25%, the highest in 22 years, while the ECB is holding rates at 4% with plans to hold that steady for the coming months. Now, this has huge impacts for investors, especially those in the fixed income market where longer-term government bond yields have moved higher in recent months. In fact, the 10-year US Treasury yield briefly rose above 5% in October, reaching a 16-year high before dropping to a 3-month low earlier this week on that slower inflation data. Well, joining me to discuss what all of this means and the impact on both bonds and equities, I'm delighted to welcome to our studio Markus Allenspach, Head of Fixed Income Research. Great to have you here, Markus. Thank you for coming. We also have Mathieu Racheter, Head of Equity Strategy Research. Hello and welcome to you as well. Now, you can ask your questions to both of our guests today. Just click on the question mark button on the right-hand side of your screen and it will come to me here in the studio. We also have a question for you up our sleeves. That's if you'd like to take part, you can click on the poll icon, which is the graph at the bottom of that screen, and I'll introduce that a little bit later. All right, well, let's get started. Markus, I want to cut to the chase here. What is your take on the level of interest rates that we're currently seeing?
Well, Hannah, if interest rates are high because we are in a capital cycle, because there is a strong demand for interest rates, that's great for the financial industry. If interest rates would stay high because of inflation worries or we worry about the debt sustainability in the US, that would be a problem. But we are firmly in the former camp. We believe that inflation will come down and these inflation worries are not justified.
Okay, what makes you so sure that inflation will come down? We've seen signs of it this week, but we also have the likes of, Jamie Dimon warning that, inflation's going to be around for a lot longer yet.
Well, inflation was not a monetary phenomenon. Central banks have been printing money for decades and it had an impact on inflation. Inflation is good old textbook 101, result of stronger demand meeting lower supply. Demand was strong because of fiscal stimulus in the US. The checks that Trump sent to the households. In Europe, we had the 750 billion next generation EU package. And supply was disrupted with this COVID and then war in Ukraine. But just this week, Mathieu in an internal meeting was telling us that one of the biggest shipping companies is warning that for the years to come, there is no oversupply in the shipping industry. So supply is back. And on the demand side, hey, this fiscal deficit cannot stay on this level in the US. And in Europe, we have next year the Growth and Stability Pact. So demand will come down. So I'm pretty confident inflation is coming back.
Let's talk about some of the homegrown issues that are affecting the United States at the moment. The debt ceiling, this has to be sorted out, I think, by tomorrow. So things are of an urgency. And how significant is that, though, for the Federal Reserve and to take this into consideration?
Just to make clear, the debt ceiling has been suspended for quite some time. You mean we need a budget?
Yes.
In the US, you have not a single budget. You have 12 appropriation bills. You have to agree. And what we have currently is a continuing resolution, so a provisional ending this Friday. But we are on track to have another provisional budget going into January, part of it February. And if at the end of the year not all the 12 appropriation bills are agreed, we have automatic spending caps next year. If they are not all done by the end of April, we'll have automatic spending cuts. But Hannah, the thing is, you are absolutely right, pointing your finger on the US fiscal side. That was the big factor we underestimated in 2023. We all expected the budget deficit to go down from 3.9 to 3.5% of GDP. We had, at the end of the fiscal year 2023, a stunning 7.5% budget deficit. Hey, if you have 4% more deficit, you don't have a recession. And you have more inflation than you had expected, so more need for the Fed to act. But again, I mean, we don't expect this fiscal stimulus to be repeated 2024.
Okay, so keep your eye on the longer term and not the shorter term.
We have a close eye on the debt issue in the US, and I couldn't agree more to an observer recently saying in the next couple of months we will look at the auctions more than at the non-farm payroll numbers. We will see whether there is appetite for this budget. But as I mentioned, I mean, we have forces saying in the US enough is enough. We got a warning shoot from rating agencies. We see that Americans are currently spending more than 3% of their GDP, or $1 out of $7 of tax revenues for interest service already. And that's getting at the point, it's getting public attention. And I think we will have from the Freedom Caucus more options. So we are pretty confident that fiscal will be not stimulative, but restrictive next year. That's one other factor why we believe inflation will come down.
All right. What about actual interest rates? When do you think the Fed will cut and therefore the other central banks will eventually follow?
There are two schools of thoughts. I mean, the Federal Reserve made it pretty clear. Hey, we have been wrong on inflation. He doesn't make any forecast on fiscal policy. Fed Chair Powell always says, I'm taking fiscal policy as it arrives at the front door. So he never makes a prediction on fiscal policy. We have to do. But on inflation, he said, we have been so wrong in the past, I don't believe in forecasts anymore. I need to see it black and white that I had achieved my target and then I cut rates. We are pretty confident, and thanks to base effect and thanks to the slowing of demand and the restoration of supply, we will have an inflation rate close to target by the middle of next year. So we expect in the second half of next year the Fed to cut rates. So that's the Fed. The Fed works on hard data, and the data will be there in the middle of next year to justify rate cuts. Of course, the market will anticipate it earlier, but that's how the Fed acts. The ECB, on the other hand, they say they still believe in projections. We have to be humble, Lagarde said at Jackson Hole. We have always to explain why we have been wrong in the past. But if we forecast inflation to achieve our target, then it's the time to cut rates. And we are also getting there by summer next year.
All right, well, I'm going to come back to you in just a moment and find out what all of this means for our fixed income investors. But let me turn to you, Mathieu. Thank you for being here today. I mean, we focus a lot on the fixed income side when we talk about inflation and interest rates. But how has this affected the equity side of things? I mean, maybe you can explain a little bit more about the relationship between equities and inflation.
Sure, yes. So in general, if you take a step back and look at yields, the relationship is not that straightforward. So, as is displayed, mostly, if you look at media, they mostly say if yields go up, that's bad for equities. It's not so straightforward. We think it's mainly due to, we can differentiate between three different factors. The one is really the context, and that's also when inflation comes into play. So what's the reason why yields increase? Is it because of better economic prospects, which would be good for equities, or is it because of higher inflation expectations, for example, which in some cases could be negative for equities? So it's really about the context why we have this change in bond yields. The second reason is really about the speed of change in rates. So it's really, usually equity markets tend to absorb gradual increases or decreases in bond yields quite well, so it's not really a problem. The problem is really if you have a shock on the rate side, be it, if you have a surprise on the inflation side that you mentioned, that's usually the scenario which is more challenging for equities. So if you have these big up moves or down moves in yields. Just to give you a recent example, the period this year between September and end of October, we had this sharp spike in interest rate from 4% to 5% for the 10-year treasury yields. And those big movements in a short time period, that's usually the challenging environment for equities. So yes, and the third factor is just about the absolute level of yield. So it's all about opportunity costs. Where could you invest? How much you get if you wouldn't invest?
And so what have we been seeing then in recent weeks, because the stock markets have been up?
Yes. Yeah, but we have, the stock market has been up despite this increase that we have seen in yields because the economic prospects have improved. So it's the point that Markus touched on. It's not because inflation expectations have gone out of control. So yields have really gone up for the right reason, which is good for the equity markets.
Okay, maybe I can ask you then, Are we still on for an end-of-year rally? Everybody always seems to talk about this at this time.
Yes, yeah, definitely. Yes, we're still in the camp. We still believe the year-end rally will continue. Obviously, we think it's a bit more front-loaded this year, so we already had a bigger performance now in November, probably a little bit lower returns in December, but we still think the setup is good. This week we just had a very good inflation print, really confirming that inflation is moving into the right direction. Yields are coming down, have probably peaked, so we rather see a decrease in yields rather than a further increase. And also, if you look at earnings, so we're really in an inflection point when it comes to earnings, and this combination of peaking and decreasing bond yields and inflection point in earnings is really a powerful combination for equity markets. And just also don't forget the fourth quarter tends to be a very strong quarter for equity returns, so usually the best quarter, so also a lot of seasonality effects kicking in. So we think given this setup, we think the markets will continue to move higher into year end.
Okay, so maybe I can ask you then, where should investors be looking at what to invest and what to avoid given this different scenarios?
Yeah, it's a good question. So, if you take a step back, if you look at our overall macroeconomic outlook, what we expect is actually a further slowdown in economic momentum, especially also now in the US in the first half next year, followed by a re-acceleration second half this year, driven by central banks becoming more accommodative again as inflation will slow. So that's really the setup we operate with. If you translate that into an equity strategy for us, that means to be still more on the quality growth side. So sticking with the winners of this year with IT and communication sectors, so those are really the ultimate quality growth sectors, but also defensives. So defensive have also suffered a lot this year due to this increase in yields, better economic growth numbers than most have expected. So I think those two buckets, we think investors should continue to stay. Which means for a regional perspective, still no rate on US, so we still like the US equity market. Remember, IT and communication makes up 40% of the whole index, so that's really a growth-driven market. And also Swiss equities for its defensive-ness there. And
it's not too late to jump on this end-of-year rally?
No, we don't think so. We think it goes up. We think maybe you also ask about something which we would avoid. I think the small cap space we will still avoid. Has underperformed over the last 2 years. We think it's not the moment to go in the small caps. This is really an area which is challenged by this higher rate environment that we are seeing. Why? If you just take the Russell 2000, which is the US small cap index, 1/3 of the constituents of the companies in the index are loss-making. Plus, 1/3 of the outstanding debt is issued at a floating rate. So they really feel this impact of higher rates due to higher refinancing costs. So despite the underperformance you have seen, this is really an area we'll continue to avoid. So really stick with the large cap quality names there.
Okay, and Markus, how should investors be playing the bond market at the moment?
No, I'm an old man, and for me, a fair level of bond yields, 5-year bond yields, is expected nominal GDP growth. When we had been below that 3 3/4, 4 1/4 level, we always said, hey, buy credit risk, avoid duration. In November last year, we changed because we got at this neutral level, and I underestimated how much we can overshoot it. But if you leave that aside, I mean, you got real yields that are too high, you got nominal bond yields that are too high, you got quality bonds now giving you, BBB bonds giving you 6.5% in the dollar, 4-5 in the euro. We also got Swiss franc foreign bond yields with quite attractive yields relative to our low inflation in Switzerland. So we recommend to lock in yields with quality bonds. By quality bonds, we had been in the high yields short duration when we thought that bond yields are too low. But I couldn't agree more with Mathieu, the higher refinancing costs for the high yield companies or the small caps. It's a miracle to me why the default rate in the US is only at 4.5, something like that. I mean, we have 18% of the index members that are not making enough money to cover the interest when they were low. And now they are high, and they're still only 4.5% defaulting. I'm still expecting a default wave to come. So be quality-minded and just enjoy the, in my view, very attractive level. Think in 6 to 12 months, we are getting closer to the fair level in bond yields. So that means you make some capital gains with bonds, and you make it with quality. you don't need to have risk. And that's why we still lock in bond yields with quality bonds.
Okay, well, any of you can ask a question to our panelists today. You just need to click on the question mark button on the right-hand side of your screen. But now we have a question for you. Because in October, we actually asked our clients where they think inflation will lie in the longer term. Will it be closer to 2% or will it be closer to 3%? You can also take part in this poll because I think that even just going from October to November, the differences might be a little bit different, or the answers might be a little bit different. So you can click on the graph icon on the right-hand side of the screen at the bottom, and that will take you to our poll, and we shall see where you think inflation will be in the longer term, closer to 2% or closer to 3%. I don't want to ask you yet until people have started voting. So there's a few people online now. Hopefully they will start voting very shortly. I don't think I'm going to give too much away to say that in October, most clients, or more than half of the clients who took part in this survey, thought that inflation would stick around the higher level at around 3%. But we still have the Fed talking about hitting their 2% target. So where do you think it will be, Markus, in the longer term?
I'm definitely in the 2% camp. That's what I already indicated when we talked about normal GDP growth in the longer term, 2% inflation, 1.75% to 2%. Real growth rate that gives you this 3.75%, 4% normal growth rate. Why I'm still in this deflation camp? The drivers of disinflation are still there. Even if we talk about nearshoring or reshoring, we still have global competition. The US is importing disinflation from China. Our commodity guys believe that energy will be cheaper in the future than it is now as a result of our whole energy transition process. So I have the goods sector without inflation, I have energy without inflation. Now leaves the service sector. The service sector in Europe and the US is driven mainly by wage growth. Wage growth has been distorted in the US when Trump was sending the checks to the households. You got more money staying unemployed than you had for working in the service industry in 2020. In 2021, we still had that. But this effect is tempers out. We see that wage growth is coming down. So I'm pretty confident that wage growth in the service sector will soon be back at the 4% level. So with 3% service sector inflation, 0 on the goods side, nothing on the energy side, we get 2% inflation. That's my back of the envelope calculation for that.
Okay, well, will it surprise you to hear that most of our audience today are actually also saying that they believe in the longer term it will lie at 3%. There you have it. 69% of people have voted for closer to 3% compared to a third of people closer to 2%. Are you surprised by that, given what you've just said?
No. The perception of consumers is always lacking. I mean, inflation is a very complicated process. You have first the drivers for inflation, but until inflation pops up in the statistics, it takes some time. So this impulse lag. And then it takes some time until consumers realize there is inflation. And because we are always making our inflation based on our most recent experience. Inflation expectations, the biggest driver on short-term inflation expectations in the US is the gasoline price. Because that's what you see on a daily basis that makes you feel. And if the gasoline prices now soon drops below $3 a gallon, I bet consumer expectations and inflation expectations and consumer survey, inflation is not a problem anymore. And in Europe, we talk a lot about wage deals, but if you look at the wage deals, we have negotiated wages at 4 and 4.4, 4.3. And that's for the compensating for the inflation impulse we had last year, which was close to 10%. So you see that we don't get a full compensation for inflation. So where should the future purchasing power comes from? So yes, it doesn't surprise me that in the surveys it's still high because your expectations are based on your most recent experience. But looking forward, I think the inflation drivers are petering out this year. So we will not have inflation next year.
Okay, thank you very much indeed. And thank you for answering our question today. We always find it really insightful to understand where our clients are thinking and what their thoughts are. Let me bring you some of the questions that you've sent in to our panel today. What's your outlook for, let me go with the first question. Have fiscal deficits ever come down during an election year? Because obviously this plays into everything, into the economics of it all, doesn't it?
It's a good question. And I mean, I made myself the horror scenario for me as a bond guy for the election year is that the Republicans remember that Trump is so popular in the US because he sent the checks home, and the Democrats always want to spend more money. So the two parties find, hey, let's party and spend more. That's a horror scenario. But I don't believe that is. I mean, the last time we had low budget deficits in an election year, when we had split power, we talked about that shortly before, when, remember, Clinton was a lame duck, a Democratic sitting in the White House, and the Tea Party in Congress cutting spending. So my big hopes for next year is the Freedom Caucus pushing their speaker, Mike Johnson, a founding member of that, saying, hey, guy, we can't sustain social spending. I mean, in the last fiscal year, social spending went up 11%, Medicare spending went up 18%. We cannot have that all the time. So, yes, it's a good question, but this time my hopes are resting that we, on the legal framework in the US, if we don't have an all the 12 appropriation bills agreed by the end of April, we get the sequestration, the automatic spending cuts. And then you could only change that by the 1st of October, but that's pretty close to elections. So yes, it's theoretical possible, and yes, it's political possible because we have this powerful Freedom Caucus in the House of Representatives who says, hey, somewhere the party stops here.
Okay, another question. What's your outlook for US dollar Latin America and US dollar Asia ex-China?
Emerging market bonds, you think?
Yes, I'm assuming so.
Okay, the emerging market bonds, it's really a lot of people I'm talking to still have in mind, hey, that's PDVSA, that's Petrobras, but 40% of the emerging market bond market is Asia, more than 40%. So Asia really dominates the corporate bond market. And for Asia, China economic activity is front and center. And we are not super positive on that one. The Chinese government is not delivering too much stimulus. Now, it also has replications. China is the most important export market for Chile, for Brazil, much more important than the US. The US is only important for Mexico. Mexico we still like, but without China really powering ahead, we can only have a hold for Latin America. So we are neutral on emerging market bonds. There are still selected opportunities. In the local market, looks something like Mexico. If you take the corporate emerging markets, yes, we have a good in-house fund to mention that, but the asset class is neutral.
Okay, well, we can't really get into any kind of recommendations at this level, but I think maybe we can kind of look, without giving too much away, because obviously we're starting to look ahead to our market outlook for 2024, but what will be the biggest risks for 2024 from a fixed income perspective, maybe aside from what we've already discussed? I
mentioned that fixed income guys are always very pessimistic. So it's a very unlikely event, but just the biggest risk for me would be a bank sovereign crisis nexus in the US. We have the US banks reporting annual profits of 290 billion. They have unrealized losses of holding treasuries of more than 600 billion. We already had the rescue of Silicon Valley Bank and First Republic in March, costing the government more than 100 billion. They couldn't recoup from the bank yet. So if we would have more banks, in the unlikely case, I mean, we would have a commercial real estate property crisis in the US and more banks coming into troubles and the market saying, hey, the US government doesn't have the money to rescue that. That is, for me, the biggest risk. But it's just something we watch carefully, and we warn our investors if we see more evidence, like swap spread spreading, like we have rumors or signs there of commercial real estate crisis getting momentum. At the moment, everything is right. That is the biggest risk for me, 2024.
Okay, and Mathieu, from an equity point of view, is it this default wave that Markus mentioned?
Yes, it goes into that direction. I think, you know, at the end of the day, when it comes to investing into equities, what you want to have is growth, right? Economic growth, which eventually translates into corporate profits. That's why we invest in equities. So from that perspective, really the biggest risk is that if the US is tipping into recession, also caused, for example, for the factors you mentioned, but also others. So in that scenario, even if that would lead to lower bond yields, if the US move into recession, that would not be a good environment for equities. So it's really about the economic outlook, I think, about growth, and our base case scenario is still for a soft landing for the US economy. So from that perspective, we think it will be a good year ahead for equities.
Another question for you, Mathieu, has come in. Artificial intelligence is a big new investment theme. We've been talking a lot about it this year here at Julius Baer. So what's the view going forward?
So we are, our next generation team here is still very constructive on the AI team. It's really a topic which will stick with us for many years to come. There are the suppliers, those who build the infrastructure, which benefits that first wave, but also then the second wave, where it's all the companies which benefit from higher productivity gains. So I think those companies who have exposure to the AI team, we think it's an attractive investment opportunity. Obviously, we have some names that already had quite a strong performance this year, but this is really a multi-year play here. Mm-hmm. And for us investors, sometimes it's difficult to think in exponential terms, and that's really a team which will go up in exponential terms than linear terms. So yes, we continue to stay constructive on the AI team overall.
Thank you very much. A final question, I think, for you, Markus. Take long position on 10-year UST and hold that until June 2024. Is this a good strategy? What do you think about it? And what is your target rate for the 10-year for this time horizon, so for the next 6 months?
Well, we have David Kohl's model forecast, which is 4.5% in 10 years. I'm more in the camp of Yves, who says 3.3% by summer next year.
And he's our CIO.
So we had always been saying, keep your powder dry, don't invest in long duration until we got to this 3 3/4. Everything above 4 1/4 I look as a reasonable good level to buy long treasuries and hold them too much, at least for the end of next year. So I'm more in, as you mentioned, in the 2% inflation camp. Fed has room to cut rates. We will speculate on that. Yes, your audience was right. I mean, I'm optimistic about the budget deficit in the US, but if that plays out, we have then bond yields, I think, more on the downside. So I like long duration.
What I like about your answer, it shows the discussions that we have going on internally, which is a key part of our secular outlook, which happens to be our next webcast from us here at the Beyond Markets team. We'll be playing that to you next month, so we'll be bringing it to you live, in fact. But for now, thank you very much, Markus, Mathieu. It's always a pleasure to hear your insights, especially on such a topical discussion. And of course, thank you to you for your participation and questions. Next month, as I say, we'll be looking at the very long term. This is the secular outlook. I'll be joined by our Chief Investment Officer, Yves Bonzon. That's on the 14th of December. I hope you can join us then. In the meantime, we have 2 podcasts for you to listen out for. Beyond Markets is a weekly podcast with all things related to the markets. But for even more regular market updates, please listen to our Moving Markets podcast, which follows the twists and turns of the markets with in-house analysis on what it means for investors. I know both Markus and Mathieu, you are regularly on that podcast. Okay, thank you very much indeed for being there. We'll see you next month. Bye-bye.